The risk that you can have sequential negative return years on your investments during your retirement is much, much higher than most people are aware of. This risk, also known as sequence of returns risk, is very likely to happen to most retirees. In this video, I'm going to show you just how likely that risk is to happen during a 30-year retirement, and then we're going to talk about ways to protect yourself from sequence of returns risk during your retirement. This chart shows a very well-known sequence of returns event, 1929 crash. What's important to note is that several of these years were not that bad on their own, but the sequence of all four is what caused people to lose about 90% of their money in the stock market during this 4-year period. The risk that a sequence of returns event could happen during a 30-year retirement is very high, much higher than most people are aware of. And most investors focus only on 1-year volatility. If you look at the majority of asset allocation profiles and the way people go about financial planning, they don't think about sequence of returns. They focus on 1-year volatility. What's the most that I could lose in any one given year? And they don't consider that they could have an event during their retirement where you have several negative return years in a sequence. You can have a conservative portfolio, but if that conservative portfolio loses, say, 8% per year for 3 years in a row, you're going to lose a lot of money. Your portfolio could be perfectly aligned with your risk tolerance for a 1-year loss, but then something like the year 2000 happens and you get 3 negative years and you end up losing far more money than you ever thought possible. As an example, what if you said, I don't want to lose more than 25% in any given year? That's how your financial planner sets up your asset allocation, and you model your financial plan on that. And if we look at the year 2000, there is no loss greater than 25% in any one of these 3 years. But as a result of -9, -12, and -22 in sequence, you ended up losing 40% of your money in a 3-year period, far more than you ever planned on losing. And this is a flaw, in my opinion, of many financial planners' approach to financial planning and investors' methodology to invest. Everybody focuses on 1-year volatility. What's the most I could lose in 1 year? But you need to incorporate the risk that something like this can happen during your retirement into your financial plan. The risk that you will have a sequence of returns event at some point during a 30-year retirement is very high. It's 97% based on the past data. There have been 125 30-year investment periods since 1871. 122 of those periods had sequence of returns events. Only 3 did not have a sequence of returns event. So 97% likelihood based on past data that if you're retiring in 2025, over the next 30 years, there are very high odds that you are going to have a sequence of returns event during your retirement. Here's a list of all the negative sequence of return events since 1871. There have only been 7. 1876, 1883, 1913, 29, 40, 73, 2000. It doesn't seem like a lot, does it? But for a 30-year retirement, as I showed on the previous slide, it's very likely that you will run into one of these events at some point during your retirement. The big danger with these sequence of return events is that people can end up losing a lot more than they ever expected they could, and then they get scared, and often they will sell at the bottom of the crash. 1973 is an interesting example. Let's say that you met with your financial planner and you built a financial plan, and the planner gave you an asset allocation recommendation based upon your risk tolerance for 1-year volatility. And you said, I don't want to lose more than 25% in any one given year. And the financial planner helps you choose an asset allocation that will stay within that volatility parameter, i.e., hopefully not lose more than 25% in any one given year. Then 1973 or something like it happens. Look at your losses, minus 15, minus 26. In this instance, you didn't really violate the risk profile of your investments in any one given year, but because of sequence of returns, you lost about 40%. And that's when people get scared. When they see their investments crater far below what they ever thought they could lose because they don't consider the potential for sequence of returns, that's when they sell. That's when they hit the panic button and dump the portfolio, and it destroys your retirement plan. Here's what a sequence of negative returns event looks like up close. We're looking at the S&P 500 from March of 2000 to April 2013. The sequence of negative returns happened in 2000, 2001, 2002. Let's say that you and your financial planner had met circa 2000 and put an asset allocation in place designed to keep your losses to not more than, say, 20% in any one given year. You're using a diversified portfolio. The big danger that I see when people base their investment strategy on one-year volatility and don't consider the risk of sequence of returns, which we've shown is very high, is that once the crash happens, they end up losing a whole lot more than they ever thought possible. They panic, they get scared, and they sell out at the bottom. And at that point, you can just throw your financial plan away. Now let's talk about how to protect yourself from sequence of negative returns event risk during your retirement. Monte Carlo is one of the best ways to go about forecasting your retirement portfolio throughout your retirement and also incorporate sequence of returns event risk. There are some issues with this, however. Number one, the forecast, which in this example that I have right here is the investment return column, needs to include sequence of returns, and not all forecasts will. So when you meet with your financial planner or you're building your financial plan, I think it is really important that somewhere in your forecast you have what you see right here, 2 years back to back with large losses. This adds a sense of reality to your forecast. That's number one. Number two, you need to be comfortable with it. In my experience, many people just brush this off. So as I stated earlier, when you're losing a bunch of money, if you sell at the bottom of the market crash, throw the financial plan away. It's worthless at that point. You need to stay invested. So when you have a Monte Carlo simulation done in your financial plan, I think it's really important that you pay attention to the time period where those negative return years show up in sequence. And you get real comfortable with the idea that, well, in 2027, I had 2.2 million, and then 2 years later, I have 1.3. Most people aren't comfortable with that, but they brush it off. My experience when going through a financial plan and showing this kind of data to people, most people just ignore it. They think it's not going to happen. Or worse, many financial planners just brush over it. Don't let that happen to you. You need to be very comfortable with the potential that this can happen. So you want to not only use Monte Carlo forecasting in your financial planning, but you have to be very comfortable with the reality that at some point, something like this is probably going to happen to you, and you need to be mentally prepared for it, and do not sell your portfolio out after a big loss. If your financial advisor isn't talking to you about sequence of returns risk during your retirement and how to plan for it, please give my office a call. We would be happy to give you a second opinion on your retirement plan. So let's add it all up. Sequence of negative returns event risk is very high, 97% based upon past data. It is extremely likely that at some point during your retirement, you will encounter a sequence of negative returns event. There are a couple things that you can do to protect yourself against sequence of negative returns event risk. Number one, when you choose an asset allocation for your portfolio, make sure that you take into account the potential for a sequence of negative returns event. It's probably going to happen at some point during your retirement. And so if you're trying to limit your losses to some number in any one given year, for example, 20%, make sure that you appreciate the fact that if you get 2 negative years in a row, you're probably going to lose a lot more than you're comfortable with respect to your risk profile. So if you lose 17%, for example, for 2 years in a row, but you set up your portfolio designed to limit losses to 20% in any one given year, you're still going to lose a lot more than 20%. And most people don't think about their investments in this way. They focus on that 1-year volatility and they set up their diversification strategy, oftentimes with the help of a robo-advisor or a financial advisor, whichever one, to try and limit losses to that risk tolerance. But then when the sequence of negative returns event happens, you're going to blow right through it. So keep that in the back of your mind and just make sure that you're mentally prepared for the fact that at some point during your retirement, you're probably going to have this happen and you don't want to sell out when it happens. The second thing that you can do is when your Monte Carlo simulation is done, make sure that it incorporates sequence of returns risk. When you study that Monte Carlo forecast, make certain that at some point during your retirement, you see 2 or even 3 sequential negative losses, and then study it. Be very comfortable with the losses that you see, because if you brush it off, if you're not comfortable with those losses, there's a very good chance that when it happens, you will panic at the bottom and sell out and completely derail your entire retirement plan. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.